In this video, we're going to talk about the 10 recession-proof dividend stocks you should consider adding to your portfolio. So before we start, please like this video and subscribe to our channel for future updates. Investors are scrambling to find the top recession-proof dividend stocks to protect their returns. What makes a company recession-proof? And why do dividends matter? For one thing, dividends are generally seen as a sign of financial strength. A recession-proof company should have strong cash flow, superior brand power, and goods or services deemed essential. During the 2008 financial crisis and the 2020 pandemic disaster, all 10 of our recommended stocks outperformed the overall market. Although past performance is no guarantee of future results, but there's good reason to think these stocks have what it takes to keep a portfolio on track during the next recession. Here are our 10 recession-proof dividend stocks you should consider adding to your investment portfolio. Number 10. Public Storage, stock ticker, PSA. Since opening for operation in 1972, Public Storage has grown to become the largest self-storage REIT in the U.S., with more than 2,400 storage rental sites spread across 38 states and more than 1 million clients. As population density increases and the population continues aging, demand for storage properties should rise over the long term, providing a nice tailwind for Public Storage. While the firm's quarterly dividend has remained frozen since late 2016, the payment appears to be on solid ground and has an impressive track record. Public Storage has paid uninterrupted quarterly dividends since 1981. The business should continue to be a cash cow given the low capital requirements for operation and the company's extremely conservative balance sheet, which has earned it a solid investment-grade credit rating. As a result, Public Storage seems to be a top-notch, recession-proof investment to take into consideration. Number 9. Kimberly-Clark, stock ticker, KMB. Kimberly-Clark, like Procter Gamble, is a proven consumer staples juggernaut that sells name brands like Scott paper towels and Huggies diapers in over 175 nations. Since demand for these goods is recession-resistant, Kimberly-Clark saw a rise in earnings and free cash flow per share during the Great Recession while only experiencing a 4.3% decline in sales. Kimberly-Clark has paid dividends for more than 80 years, including annual increases every year since 1973. That streak should continue regardless of the economic environment. Number 8. Duke Energy, stock ticker, DUK. The largest electric company in the nation, Duke Energy, provides service to 7.6 million consumers in 6 states in the southeast and midwest of the United States. In addition, the company serves 1.6 million consumers for natural gas, creating a highly diversified, reliable, and regulated cash flow source. Duke Energy has one of the industry's largest approved growth backlogs, which totals $37 billion in planned investment between 2018 and 2022 that should deliver predictable returns. Duke Energy's financial stability adds to its appeal as a recession-resistant investment. Due to the company's strong A credit rating, Duke Energy has been able to get all the funding it needs to carry out its growth plan. And during the financial crisis, Duke Energy's shares slumped just 34% while the S&P 500 tumbled 55%. In other words, Duke Energy, with its strong balance sheet, highly stable cash flow, and steady dividend growth, is a good choice for low-risk income investors during recessions and bear markets. Number 7. Walmart Incorporated, stock ticker, WMT. Walmart may be the firm that has always weathered economic downturns best. That's because the focus of its businesses is on providing consumers with cheap access to necessities like food and personal care products. For a while, people might refrain from purchasing in upscale stores. But people frequently need to buy things like bread, toothpaste, pet food, and other basics. And whether they're visiting the store or shopping on Walmart's developing e-commerce website, they might also end up purchasing some additional luxuries. Walmart has cut its earnings outlook, which has hurt the company's price during the past quarter. Currently, Walmart's financial health is superb, with a modest debt-to-capitalization ratio of 46%. Although the stock is trading at 25 times earnings, the company has a track record of resilience during difficult times. Number 6. Procter & Gamble, stock ticker, PG. Procter & Gamble is one of the leading manufacturers of consumer goods in the world, with annual sales exceeding $80 billion. Leading brands include, among many others, Tide, Pampers, Gillette, Duracell, Crest, and Febreze. The business struggled with organic growth for a while. However, the company changed its focus in the middle of the decade. While doubling down on its best products, it sold off dozens of lesser-known brands. Once 2020 arrived, this paid off significantly. P&G's emphasis on cleaning and hygiene goods in particular delivered. P&G has increased its dividend for 66 years running, so investors can depend on it to continue doing so. Number 5. McDonald's Corp. Stock ticker, MCD. McDonald's was one of the key blue-chip companies with the best performing stocks throughout the financial crisis of 2008, and it also recovered swiftly in 2020. McDonald's profits from consumer cost-cutting. In fact, some experts have jokingly remarked that McDonald's is a commercial real estate corporation that flips burgers on the side because it owns so much of its own real estate. McDonald's balance sheet is safeguarded by its massive global real estate portfolio. Number 4. Home Depot, stock ticker, HD. Home Depot stock has been tanking recently. This is on fears of a major downturn in the housing market as interest rates soar. However, Home Depot's performance is only modestly tied to the new home market. For proof of that, look at 2008. For that year, the S&P 500 plummeted 37%. And the 2008 market turmoil was caused, in large part, by the collapse of the American housing and mortgage markets. Yet, Home Depot stock only dropped 12% in 2008. While people may not be buying new homes, they still repair and take care of their existing ones. And also, during down housing markets, a lot of people move due to foreclosure or to downsize, and these events tend to cause a flurry of home maintenance activities. Additionally, some hobbies, such as gardening, can save people money and gain popularity during recessions. Long story short, a recession shouldn't crush Home Depot. Number 3. Pfizer Incorporated, stock ticker, PFE. Pfizer Incorporated is an American multinational pharmaceutical and biotechnology corporation. Given the company's participation in pandemic-related items, that naturally makes sense. However, it wasn't merely a result of the vaccinations. There are some aspects of the pharmaceutical sector that are recession-proof. Regardless of how the economy is doing, people still require their life-saving medications. A recession is also unlikely to result in lesser remuneration for Pfizer in situations where the government is negotiating the price because politically motivated purchases often follow a distinct set of economic principles. PFE stock continues to trade at less than 8 times projected 2022 profits even after its recent rally, and it yields more than 3% in dividends. Number 2. Johnson & Johnson, stock ticker, J&J. Johnson & Johnson is situated in the middle of Pfizer and P&G. Pharmaceutical medications, J&J's main product line, have the same recession-resistant qualities as Pfizer's. The consumer products division of Johnson & Johnson, meanwhile, demonstrated its resilience during the 2020 recession and earlier downturns. J&J also operates a substantial medical devices section in addition to those two businesses. With this combination of business units, J&J is more likely to always have at least one outperforming division that can support the rest of the organization. This should be the year of medical gadgets as hospitals resume regular operations after pandemic. J&J is a fantastic income stock as well because it has increased its dividend for 60 years running. Number 1. Kraft Heinz, stock ticker, KHC. Food is right up there at the top of the list of necessities for people. Kraft had one of the better years among the Dow components during the difficult year of 2008, according to data. In 2012, Kraft divided into 2 separate companies, spinning off the beverages and confections division of Mondelez International Incorporated. That opened the door for the historic merger with Heinz. While there have been problems with that combination, Kraft Heinz showed its strength during the recessionary pandemic. By the middle of April, the stock had recovered its March 2020 losses, and since then, it has dramatically increased. Like McDonald's, when times are tough, people trade down to Kraft Heinz's more affordable products. And, with inflation running rampant, Kraft Heinz's large size and well-known household brands should give it operational resiliency. In the meantime, shares yield more than 4%. Which of these recession-proof stocks would you like to add to your investment portfolio? Let us know in the comments below. Thank you for watching and don't forget to subscribe to our channel for new weekly investing videos.